Good morning and welcome to this July 5th, 2023 edition of Trading Places Live. I'm your host, Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'm looking forward to sharing with you some of the things you need to prepare or need to know to prepare for today's trading day. We do see futures down this morning. We're going to talk about that in just a minute. I do want to share with you first, though, before we get started, a couple of things. First, I want to take you over to earningsbeats.com. We have a really big event tomorrow night. It is our Bullseye forecast mid-year update. So if you're interested in my take on where I think the market's going and what I think of the first half of the year, and really it's just an update of a lot of the things that I like to use to signal whether or not I believe the market's going higher or lower. So we'll go through a bunch of that. It's going to be a really educational event. We will try to go through some of the key areas of the market that we like to look at in order to help determine whether or not the current rally is sustainable. I think you'll really enjoy it. If you go over to earningsbeats.com, we do have a link to this event. Seats are limited, so you do want to make sure that you get signed up and registered. If you click on this link, it will take you to a page where you can sign up. Now, when you hit the sign up button, it's going to take you to the bottom of the page where there is an area to put your name and email address. That's how simple it is to sign up. There's no credit card required. And we will make sure that you're also set up for our EB Digest. That's our free newsletter. If you're already signed up for it, no big deal. This will just sign you up for the event. But once you're signed up for the EB Digest, you can unsubscribe at any time. So if you don't feel like it's really helping you, or if you just don't see the worth in it, then you can unsubscribe at any time. We'd love to have you join us. I also want to mention, when you come over to this page, you'll notice at the top that when you register, you'll get a download. It's a PDF titled Money Flows. And this is something that is really near and dear to my heart. I started studying money flows and some of the impacts it had on the stock market back in the 1990s, and I just continually update it. But if you trade the market, if you're more short-term, maybe even swing trader, like to hold a couple of weeks to a couple of months, that type of thing, I think you're going to find some of this information very fascinating if you haven't already heard it. I don't really hear too many folks talking about it other than me. But I think it's a really, really important part of trading. Now, if you're more of an investor, long-term investor, you may not get a whole lot out of it. I still think you'll find it fascinating. But I think it really more applies to those who like to trade short-term. And I think over time, you'll find that it has a very, very positive impact on your trading results. So anyhow, when you register, we'll make sure we get that sent out to you. So it's really a no-brainer. I'd love to have you join us. This event will be Thursday evening at 7 p.m. Eastern time, so 4 p.m. for those of you on the West Coast, and obviously many different times around the globe, so you'll have to figure out when that is, but it is Thursday, July 6th, 7 p.m., so that's tomorrow night, and we'd love to have you. Let's take a look and talk about what happened on Monday before the holiday. And by the way, I hope everyone had a nice 4th yesterday. We've got the Dow Jones Industrial Average, which gained 11 points on Monday. S&P 500 was up 5. NASDAQ was up 29. Mid caps up 8. Small caps up 7. So on a percentage basis, we did see a little bit more strength in the mid caps and the small caps. That was good news, and something that I'm really looking forward to more of as we go forward. Small cap still trying to make that breakout. As you can see, the S&P 600 small cap index right at about the 1220, 1225, maybe even 1230 area. That's where we've been stalling. The rallies that we've seen throughout June and into early July, we seem to get right up to that level and haven't been able to get through. Personally, I think it's just a matter of time. I see the market going higher. I see the small caps going higher. And we'll talk more about that on Thursday evening. Transports, also another very, very solid day. I've been talking about transports ever since we went through the 14.5 level. That was about 3 or 4 weeks ago. This has been a straight up move, 14.5. Now we closed Monday at 15.6. So that's a good solid 8% or more that we've had moving up in just the last 3 or 4 weeks. Really, really strong move in the transports. Looking at the sectors, we had discretionary stocks up 1.2%. I looked, and I think discretionary is the leading sector. It was the leading sector Monday. It's been the leading sector for the last week, the last month, and the last 3 months. And year to date, it's actually gaining rather rapidly on both communication services and technology. So discretionary stocks really getting a move to the upside, seeing a move to the upside. And a big part of that is Tesla. Tesla's had a huge move. Tesla's a big component within the XLY, along with Amazon. Amazon also moving to recent highs of late. So those two stocks, which had been in the doldrums for a while, which is why discretionary had lagged for a bit, those two have absolutely been set on fire, especially Tesla. Tesla's trading like its hair's on fire. And as a result, discretionary stocks have been moving to the upside. Real estate finally starting to make a move. And notice on the chart here, we had struggled at about 37.50 to 37.75, made a move, went up above 38, closed at 37.99 on Friday. We got a nice little breakout there in real estate. And you might say, well, that's defensive. That's bad. That's not bad. When the market's going up, we want wide participation. We want every sector moving higher. We just don't want real estate to be the leading, among the leaders on a relative basis over an extended period of time. But to go higher, yes, absolutely. We want everything going higher. Healthcare, also trying to make that breakout through 132.50, pulled back on Monday. I think this one could be the next one to make that breakout above that 132.5, 133 level. It too has been weak, kind of like real estate, going sideways for a while. And it was the worst performer on Monday, but I see this one turning back around and breaking out probably sooner than later. Automobiles, and that's again testament to how strong Tesla has been. But on Monday, automobiles up over 6%. Tesla had another huge day after reporting its production and deliveries for the second quarter. Hotels and lodging REITs had a nice day, which of course led the real estate group to the upside. But this index was up 2.92%, almost 3%. That was the top performing industry group within real estate. And then medical supplies, if you want to know why healthcare struggled a little bit on Monday, medical supplies, which has been on fire since breaking out of a bullish ascending triangle, finally saw a little profit taking yesterday. So we did see that group down about 1.75%. Moving on to the 10-year Treasury yield. And let's get a quick update here. So right now we are at 3.87%. You can see that we are in the short term continuing to trend to the upside. We did pull back a couple of times the last month and a half. And each time we seem to be contained by that rising 20-day EMA. And now we're moving up and breaking out again. Got as high this morning as 3.89%. But we have pulled away from the 20-day, which currently sits at 3.77%. All right. I do want to mention, bear with me one second, that on Thursday, we're going to be having the June ADP employment report. Normally, that's a report that would come out today on Wednesday, but because the holiday, it got pushed back a day. So on Thursday, tomorrow morning, we will get the June ADP employment report. May showed jobs of 278,000. June, according to the ADP report, is expected to come in at 235,000. So still positive, but coming back down a little bit, which I think is good. Friday, June non-farm payrolls will be out. May was 339,000. Remember, we had a pretty good surprise to the upside in May. That's expected to drop back to 213,000. So for those who maybe are looking for the economy to weaken, but still have a soft landing, these are the kinds of numbers that I would look for. Positive jobs numbers, but slowing. And I think in terms of what the Fed's looking for, that would be what they would be looking for. They're looking for a slow landing. They want to slow the economy, but they don't want to trigger a recession. So it's really been a balancing act between trying to make sure that they're ahead of the curve or catching up on the curve. I don't think they were ever ahead of the curve on inflation, but they're trying to remain still going with the curve, if you will, continuing to raise rates, talking like they're going to raise another 1 or 2 times as we head into the summer, late summer, and maybe even early fall. We'll see whether or not that comes to fruition. Sometimes you have to understand the Fed will talk about things and say that this is what they're going to do in hopes that the market reacts in such a way that they don't have to actually follow through with it. And a perfect example of this was back in during the 2018 trade war in the fourth quarter, right around the Christmas holiday. I remember the Fed Powell talking about they were going to raise rates twice in 2019. Of course, we had the trade war. We already had some economic issues. And I said at the time, there's no way they're going to raise twice. And I said, I think the next thing they're going to do is cut rates. And they never did raise. And come June, or maybe it was July the following year in 2019, they actually cut. So just because they're talking more interest rate hikes doesn't necessarily mean we'll see them. I think it's going to be data dependent. I think that right now there is maybe another 1/4 point priced in later this month. So I wouldn't be surprised if we see that one. I don't know how much data we're going to get that might convince the Fed not to raise, but I wouldn't bank on that second one, not yet. Anyhow, 10-year Treasury yield been moving up, and today's economic news, there's only a couple of reports that we have. One is the May factory orders coming in. That'll be in later this morning. April rose 0.4%. May is expected to increase to 0.9%. But I will point out it's May. We're talking about April and May, which is in our rearview mirror. There also will be the Fed minutes, FOMC minutes, that will be released today at 2 p.m. So make sure you're aware of that. You may see some market volatility around that 2 o'clock time based on the minutes. All right, let's move on, talk a little bit about what is going on with some of the key indices in the market. S&P 500 broke out again to a new high on Monday. That's good news. Bad news, or maybe at least cautious news or news to be aware of technically, is that when we broke out at the end of last week, notice that the PPO is turning up, but we have a negative divergence. So here is your lower PPO, and then here is your higher price. Now, what I normally look for with that is a reversing candle. So if I get a reversing candle, if all of a sudden we're strong in the morning, and then we have a really weak afternoon and we finish with some sort of a bearish engulfing candle, or a dark cloud cover candle, or maybe a doji, shooting star, where you gap up, trade up intraday and come back down, close near the low or at the low. Those are some things that I would maybe be looking for. Usually, I know futures are down this morning. Normally, that's not the way market tops are made, even short-term or intermediate term tops. Normally, when you move up, you do see some kind of reversing candle. You get some type of a false breakout to the upside, just to bring in those last few buyers before the market reverses and goes back down. So today's potential gap lower with futures down, which I don't know if I actually said what futures were. Let's go back and take a look at that. Dow futures right now, by the way, down 193 points. S&P 500 futures down 24. NASDAQ futures down 84. So on a percentage basis, they're all down just a little bit more than 0.5%. Not a huge amount, but still, down is down. So we are looking at a little bit of a gap down. Crude oil prices up $1.44, 71.23. I'm going to be talking about some of the sectors, and I could see, I know normally this time of the quarter, right as we're getting ready to go into earnings, we tend to see a move to the upside, and sometimes it's led by some of those technology companies. But we've seen such a run up already there that I'm beginning to see some of these other breakouts, like I showed you already on real estate, materials, financials. These are all just starting to break out in the short term. So I could see a little bit of rotation here into some of the areas that had been lagging. We might see a little bit of outperformance there for a period of time. And with crude oil prices up again this morning, $1.39 right now, that's 2% higher and back above $71 a barrel. This could be a catalyst to see energy moving up. We were right at a key resistance level, and I'm going to show you that in just a few minutes. But that's something I would be looking for today. U.S. 10-year Treasury yield, 3.87%. That is up 2 basis points, and we talked about that. We looked at the chart just a couple minutes ago. All right, looking at the NASDAQ 100, the NDX, very similar. When you look at this and you say, well, PPO's lower, but we haven't made the breakout yet. Therefore, we don't have a negative divergence. Well, I would offer you this tip as far as divergences go. Sometimes it's difficult to see whether or not you have a closing high in terms of price when you use a candlestick chart. Because this, you look at it and you say, well, here's a candlestick well above 15,250, and we're below that now, so we don't have a higher price, so we can't have a negative divergence. Well, what I would say is this: negative divergences come when you have a lower PPO or a lower MACD, or some you like to use the RSI or stochastics. I do not like to use either one of those for divergence calls. RSI better than stochastics. But if you have stochastics that go up to 100 and you're waiting for a higher stochastics reading, if you know anything about stochastics, they're bound. They don't go above 100. So you can't have anything but a negative divergence when prices go higher, because that particular oscillator is bound at 100, and it will get to 100 or close to it frequently when you're in an uptrend. So showing some sort of a divergence on the stochastic makes no sense whatsoever to me. I mean, I just don't understand the logic of it. RSI is a little bit different in that it is bound by 100, but it rarely gets up into 100 or even close to it. Usually we're overbought when we get to 70. And if we start getting into the 80s, we're really, really high on the RSI. And so if you see a reading on the RSI at 80, 82, chances are after a pullback, when you go back up again, you're not getting close to 80. So I can almost tell you that we're going to print a lower RSI before it happens. That is not really a negative divergence. That's not necessarily telling me that there's slowing momentum in the market. So I'd be careful using the RSI, and especially stochastic. Now, if you're using the PPO or MACD, then yes. When I get lower prices or lower PPO or lower MACD and prices are moving up, then I think you can get a negative divergence that can be very meaningful to you in the short term. So if I look at this chart using the candle chart, you can't really tell whether or not we've had a higher close, right? So let's go down here and let's change this candlestick to a line chart. I don't use line charts very often. I like to use them when I'm looking at relative strength. I think candlesticks with relative strength, you can see a lot of noise and a lot of ups and downs and opens versus close. It's just weird. But if you're just looking to see from a daily perspective, are you trending higher on a relative basis? You want to use a line chart, in my opinion. Now, here on this chart, you can see now that on a closing basis, it does look like we went to a higher high on the NASDAQ 100. I'd have to actually go in and look at the closes, but it looks like we edged out and set a new high. So technically, we are sitting right now with a negative divergence on the NASDAQ 100. Now, it just started, and sometimes what happens, it's kind of like those that like to use breadth as an indicator to maybe talk about the strength or weakness of the market, the underlying technicals, a lot will say. And so when, a month ago, or maybe 2 months ago, or maybe a couple of weeks ago, the market was going higher and everyone was talking about breadth, that we couldn't go higher, or it wasn't likely that we'd go higher because not enough stocks are participating. Breadth was not breaking out or even close to breaking out. Well, now nobody's talking about breadth. Why? Because as prices have gone up, everything else has gone up and caught up or started to catch up. And now a lot of the breadth numbers are fine. So you got to be careful with breadth. And that's the reason I don't use it. I've been asked that question a lot. How come you don't ever talk about breadth and, bad breadth? And the reason is that if I have other signals, many other signals that suggest we're going higher, the breadth is going to catch up. We're going to go up, and then the breadth is going to go up with it. And then everybody's going to be fine. They're going to stop talking about it. And oh, by the way, when they look back for all of the prior signs when breadth showed that it was a topping signal because breadth wasn't, going along for the ride. They always point out the ones that work, but when they don't work and breadth picks back up, you can't even see it when you look back. You don't see it because the breadth ends up going higher. Well, the same thing can happen with a negative divergence. So if prices keep going up, this PPO on the NASDAQ 100 could go up with it and set a new high. And if it sets a new high, there's no more negative divergence. And prices have kept going up. But if you look at it today and you simply trade on what you see today, you would maybe get out of your positions in the NASDAQ 100, or maybe you would short because you see a negative divergence. I would say it's going to take a little bit of patience. That's why I look for that reversing candle. I look for some other corroborating evidence that suggests we're topping, not just the negative divergence. And if you look at almost any move up in an uptrend, look back in March. Do you see when we broke out here on the NASDAQ 100 at the end of March? Now, when we broke out, if you wanted to look back, I think this is too far to be looking back on a daily chart, but I see people do it all the time. We make this breakout, and right here, you look and you're like, oh, the PPO is way below. And then it keeps going up, and the PPO is still way below. We go sideways, and then we keep going up. And it's not until we get all the way over here in June that the PPO actually moves back up slightly above where we were in February. So my question to you is this: if you're playing these negative divergences, how'd they work out for you? Didn't work very well. And I think there are a couple of reasons for it. Number one, anytime we get a PPO centerline test and a 50-period test, I consider that what I call reset on the PPO. So I'm not interested in anything left of that. I don't care about this top anymore, because when you get to a zero line on the PPO or the MACD, that's when there is no more momentum. Your short-term moving average and your long-term moving average, by definition, is at zero. There's no momentum in the market. So when you look at this next move to the upside, to me, you're looking at apples and oranges, because anything that's in this calculation of the PPO, which is 12 and 26 days, none of it was included back at that prior high, because we're at least 26 trading days beyond it. Anyway, I could talk about the PPO and the MACD and divergences, and we could turn that into a whole day-long webinar. So I'm not going to go any further. But just understand that this PPO, kind of like breadth, if we keep moving higher, this PPO will turn back higher, and all of a sudden, the negative divergence will go away. And when I look back at divergences, the only ones that you'll see on the chart that worked were the ones that worked. It's like 100%, it's absolute. Every one of them are going to work when you look back in hindsight. But in real time, many of them didn't work. But as prices keep going up, the PPO goes up with it, and it eliminates. And so you don't see it when you look back. Anyway, I love technical analysis, and I use technical analysis all the time. But every single indicator has its limitations. And you need to understand the limitations along with what the signals represent. And anyway, again, I'll move on because I could spend a lot of time just on that. Here is the IWM, and I'm bringing this up because I think the IWM is going to break out, and I think we're going to go higher. In the short term, well, we hit resistance. We kind of pulled back. We got futures down this morning. Maybe we go back to the 20-day. I'd be surprised if we were to go much lower than that. But perhaps in the short term, we pull back. But down here on the bottom, what I did is I set up 5 different correlations with the IWM. IWM with the XLE, IWM with the XLF, IWM with the XLV, IWM with the biotech index. There's a lot of small cap, mid cap, a lot of small cap biotechs. So I was like, okay, let's see how correlated the IWM, which is a small cap index, is to the biotechs. And then also I did the IWM and the transports. And the whole purpose of this, and this isn't something I routinely do, I just decided this morning to take a look at it. But the idea here is to see over the course of the last year, which of these areas has correlated most positively with the IWM, so that if that area starts to move, that might be the indication that says, hey, the IWM is really about to take a big move to the upside. And I say that because almost every other area in the market is doing that. We saw that first with the QQQ. Many of those FANG names, they took off before a lot of the rest of the market. And now we're seeing it start to catch up in some other areas. Industrials now at an all-time high. Now up above the 107 level. We've seen transports. I talked about those earlier. 8% move in the last 3 or 4 weeks. It's happening one area in the market after another. It's almost like this rolling rotation that we're seeing. So looking at these, I see all of them having some positive correlation with the IWM, but the one that stood out to me was the financials, which is right here. And I'm going to go back and let me just make this one a little bit bigger on the chart. We'll make the height a little bit bigger. Just so you can see, I mean, we have been hanging out above 0.5 percent correlation, positive correlation the entire year. We went down a little bit in April. Remember the banks and the financials took a pretty big hit. The IWM went down initially in March and then just kind of went sideways. And so that's where we saw the really strong positive correlation kind of go by the wayside just a little bit. And then we came right back up again. So it makes sense to me that maybe the financials, we need to see, the financials making a move. Well, let me show you something. Here are the financials, the XLF. Look at this essentially it's double top. Here was the big drop back in March. Here was your reaction highs. We just went down, hit the moving averages, and just broke out again, which is something a little different than what we had been seeing. Here on this rally in April, we went back down well below the moving averages. Came back up in June, however, and actually even had a little bit of an intermediate move up here in May, back through the moving averages, back down below the moving averages. This last one's been just a little bit different. Here we move up in the middle of June, and when we pull back, we hold on to this low, and now we've moved back up and set new highs. We hadn't seen anything like this probably since back in the beginning of the year. So financials are starting to move, and IWM has been tracking this group the closest. Will it matter? Well, I think we're going to find out. So let's, speaking of these sectors, I wanted to go through and talk about some of these. And so let me show you first. Actually, I'm going to start with the XLK. So the XLK, kind of like the NASDAQ, if we make a breakout, we have a negative divergence. Now, there's no doubt whatsoever this has been a hot group. So in terms of, excuse me. So in terms of maybe what's hot and what's not, I would say technology clearly has been hot. But if you're asking me, what might continue to be hot, this one's got a question mark because we're seeing that PPO. We've had a huge run. There's nothing wrong with XLK going sideways for a little while or even having a pullback. So I think it's possible. Would I avoid technology? No. I want to make sure that I am still well represented. Would I overweight technology at this point? Probably not. I still want to have solid representation, but if I was maybe managing an ETF portfolio, I would maybe take some of the profits off the table with the XLK and take a look at some of these other sectors that are starting to make breakouts, like the XLF, like the XLE, XLB. Materials have been strong. Real estate, just talked about that, just made a breakout. Anyway, I'm going to show you these charts right now. So and then let me see where we are on time. All right, market's about to open, so I'm going to try and make this quick, and then we'll wrap up. Oh, I do still have the chart of the day. All right, we'll make this really quick. XLK, I think you want to be in it, but I'd be a little bit more cautious with the negative divergence. XLY, similar. Made the move up. This is clearly a breakout. PPO got some work to do. If you see a reversing candle here or on something like the Tesla chart, I'd be a little careful in the near term with the XLY. XLC, same thing, trying to make a breakout. We got this slight negative divergence. So those are three that I think have been performing great. They've been hot, but they're starting to show just a little bit of sign of wear and tear. So we could see a little rotation. Where could we see that rotation go to? Well, first I'm going to start with the XLI. Higher highs, higher PPO. We still got solid momentum in the short term. Here was the breakout above that 103 level. All-time high, I think, came when we broke above like 105 or 105 and change. We got up to 107 and change, and we're pulling back a little bit, but I still like the XLI. XLF just making that breakout, pulling back a little bit. But when I see this breakout, I start thinking uptrend. So now that rising 20-day moving average is going to become key here for financials. XLP, this is consumer staples. Look at this move up on Monday, making a slight breakout. Starting to see a little bit more bullish action, bouncing off the 20-day and moving to a new high. At least starting to show some bullish characteristics here. The XLRE, let's bring that one up. Even highs going across here at 37.50, just made that breakout. I like that. XLV healthcare, I think this breakout was made, and I think we're going to bounce off these moving averages. Somewhere around this 131 area is where I would look for the XLV to perhaps start to move back up again. XLB already broke this downtrend line. So and it's been bouncing off the 20-day. I see a trend there moving to the upside. I would call that one bullish. Neutral at this point would be energy, only because we haven't gotten through this 82 level. The PPOs turned positive. We did gap up this morning with the higher crude oil prices, but we've pulled back a little bit. On a relative basis, seems to be outperforming the market. And if you see this one go through $82, we could continue that recent uptrend. So it's neutral, but starting to show some bullish characteristics. I want to see that breakout. And then the one that I am maybe the most cautious about would be utility still at this point. I mean, we've been downtrending for many months. We got multiple lows down around 63. So if you want to play the long-term support game, then utilities look better when we get down to around 63. We did get back up through the 20-day, but we saw that recently. We failed. Even today with the market down, we're maybe seeing a little bit of relative strength in utilities, but we're not seeing any absolute strength. And that's just still a little bit worrisome. So of the 11 sectors, I could make bullish arguments really on 10 of the 11. Utilities is the one that still not really seeing much. We got negative PPO still in the short-term downtrend, intermediate term downtrend, and even a longer term downtrend. So I would be careful still with the utility group. Last thing I want to show you is wanted to just again tell you about this Bullseye forecast for those of you that came in late. We do have registration open. This is tomorrow night. It is a free event. It's going to be a lengthy event, but we will timestamp the recording. So you'll be able to go exactly to wherever you want within the recording quickly. I mean, I think it's going to be an awesome. I always think anytime we take a step back and look at the overall big picture and start going through, looking at sentiment, looking at the dollar, looking at gold, looking at the transports, all the various sectors, are relative ratios, all of those things. Anytime we go into all that, I think it's important to go through that refresher. I do it. I don't do it every day, but I like to do it probably every month to a quarter. Some of those really big picture charts, just to make sure I'm not missing anything, that nothing huge has changed. And so we're going to be taking a look at all that. You can sign up by clicking on that Bullseye forecast and then just hit the sign up button. It'll take you to the bottom of the page. And then from there, you just enter your name and email address. No credit card. So you don't have to worry about that. And we'll then set you up with our free newsletter, which you can unsubscribe at any time. All right, so today's chart of the day, and by the way, when you get that EB Digest, it's a 3 times a week newsletter. That'll be a little bit about what I'm about to show you here on MicroStrategy. This was actually our chart of the day that we sent out as part of our EB Digest this morning. And I want you to notice here that we made this breakout to what, roughly a 11-month high, 10 or 11-month high. And PPO looks good. Look at the AD line strengthening. This is now the highest we've seen probably in close to 2 years. So the AD line looks good. Everything about this stock looks good, except I just want to mention one more thing about it. It's one of the most heavily shorted stocks in the market. There is more, it's almost 26%, the short percentage of float. And the reason that's meaningful, when you make a long-term breakout like this and the volume is above average, anyone who has shorted MicroStrategy over the course of the last 13 months, 14 months, every single person is underwater right now, meaning that they're losing money. And if you understand one thing about short selling, it's that your risk is unlimited. Your losses are unlimited when a stock begins to break out. Imagine having shorted Tesla before it made its huge run. Or you pick anything that makes a big move to the upside. I mean, I talked about Tesla. I wrote about it a few years ago when it made its first major breakout above, and this was pre-split. I think it was like 100, or maybe that was after that. Maybe that would have been it was post-split. Maybe it was 400 pre-split, but that was before it split 5 for 1. I mean, Tesla made a huge move. A lot of that, it was the highest dollar volume shorted stock at that time. Now, this is percentage. This is based on the short percentage of the float. And the float is the number of outstanding shares that are available to trade. So if you get a really high percentage of short interest, when you start seeing breakouts, not only do regular, traders that are buying on the long side, not only are they buying these breakouts, but then as the stock keeps moving up, the pressure grows. It really begins to mount on these short sellers that have to buy the shares in order to return their borrowed shares back to the broker. So as it goes higher and higher, they just lose more and more money. So a stock like MicroStrategy, when it makes a breakout and is on the short squeeze, our short squeeze chart list, you want to watch. Now, I haven't looked at anything. I don't know if it's going up today or not. I'm going to pull this up and just see on the daily chart, and we'll just do it on a 1 year. Today it's down. Now, I would say, if you look back over the last, I don't know, really since back when it was 270, most days since then, I would say probably at least 70, 80% of them, we've been seeing higher lows on a daily basis. So I would simply watch MicroStrategy and see if it goes down below Monday's low. And in fact, as it gets closer and closer to Monday's low, those who are really aggressive could maybe take a position. Or if it makes a breakout, you might just simply wait and see if it moves back through that 380 level, because at that point, if you buy, you might be buying with a lot of other short sellers that are really starting to feel the pressure. The other thing to watch, if it does start to make a move to the upside, watch this volume. It's been above average, but it hasn't been what I would consider short squeeze volume, which I think will be the highest that you'll see on the chart going back the last 52 weeks. So I would be looking for 3 million shares or more. When we start moving at that pace, that's when it's going to start looking like a short squeeze is underway. All right, went a little bit late, so I apologize for that. Real quick on the market, let's just see where we are. Dow down 134, S&P down 14, NASDAQ down 32. Notice the percentages are down from what we talked about in pre-market. They were up over 50% down. Now NASDAQ down less than 0.25%. The S&P 600 small cap, so we got small caps down 1.36% last week. And then, you might question, well, why were you selling the TNA last week? This is why. We were up against resistance. No guarantee we're going through. And now, as it pulls back, you can always begin to reestablish that position. Anyway, that's all I have for today. I appreciate you tuning in. Please remember to hit the like button below. Also, subscribe, because we are going to be making some changes as far as our broadcasts go, our live stream broadcasts right here on YouTube. And so if you are a subscriber, you'll be able to keep up with us when we do these live events. I'm not sure what the time's going to be. Sometimes you can just kind of click in. Right now, we start right around 9 a.m., but some of that could change. So please make sure that you hit the subscribe button below as well. Have a great day, everybody. Happy trading.